Hey there, welcome back to Investing Path. In today's video, we're diving deep into Warren Buffett's method for calculating intrinsic value. We will hear from the man himself, and then we will walk through a practical example together. But before we jump into that, let's start with the big picture. When it comes to valuation, our goal is to view a business as a money printing machine. We want to determine the right price to pay for this machine so we can enjoy a solid return on investment as it continues to generate cash in the future. To do this, we assess the entire business and calculate how much we'd pay to own it entirely, considering its annual cash flow. Once we determine this value, we can compare it to the current market capitalization, which represents the total stock market value of the company. If the market cap exceeds our intrinsic value, the business is overvalued. Conversely, if the market cap falls below our intrinsic value, it's a promising sign because the business is undervalued. Simple, right? According to Warren Buffett, finding the intrinsic value of a company involves predicting its future cash flows and discounting them at an appropriate rate. The goal is to determine how much we should invest today to receive a good return on investment in the future. When valuing stocks or bonds, it is easier because the cash flows are explicitly stated. However, with stocks, we need to analyze and estimate the future cash flows based on the business potential. This analysis requires assessing the amount of cash the business will generate and when it will be received. When calculating the intrinsic value, we always approach it as if we are buying the entire business. We consider what the business will generate, and then it will be distributed. Ideally, the business should be able to utilize its earnings and generate higher returns over time. For example, in the case of Berkshire Hathaway, the question would be whether the company can distribute enough cash in a timely manner to justify the investment at present interest rates. To answer this crucial question, we employ a process called discounted cash flow analysis, which is essentially the discounted present value of all the future cash flows. This analysis allows us to determine what price to pay for the business now. Considering the projected cash flows over a specific period, it involves calculating the free cash flow of the business, which represents the cash available to the owners after deducting expenses. This is derived from the cash flow statement, specifically the cash flow from operations minus capital expenditure. Next, we need to estimate the business growth rate in cash flows over the next 10 years. It is important to exercise caution and avoid overly optimistic growth projections. Using a realistic and conservative growth rate is crucial for accurate intrinsic value calculations. A growth rate of 25% per year, for example, is already considered quite high. Remember, finding the intrinsic value requires careful analysis and research, and the growth rate you choose will significantly impact the value. So, it is essential to remain grounded and avoid unrealistic expectations. So overall, to stay grounded, we consider a few factors. Firstly, we examine the past 10 years of free cash flow and equity growth to understand the business' historical performance. Secondly, we assess the industry's typical growth rate to gauge what other companies in the same sector achieve. Finally, we analyze the future growth drivers specific to the business and their impact on cash flows. For example, in the case of Tesla, we consider the effect of new factories on vehicle deliveries and free cash flow. Taking these factors into account, we can arrive at a reasonable annual growth rate for the business. Let us assume a growth rate of 10% per year for this example. We then project the free cash flow to increase by 10% annually for the next 10 years by multiplying the previous year's free cash flow by 1.1. Next, we turn our attention to selling the business in 10 years. Although it is not necessary in reality, we determine the potential selling price by considering the multiple of free cash flow the business has commanded over the past 5 years. Let us assume a multiple of 25.5 times free cash flow for this illustration. To calculate the terminal value, we multiply the free cash flow of the 10th year by the determined multiple. Now, we have all the future cash flows. However, we need to account for the time factor, as emphasized by Buffett. The present value of $1 today is higher than of $1 in the future due to opportunity cost. By discounting the future cash flows at our desired annual rate, say 15%, we incorporate this time factor. It is interesting to note that as time progresses, the present value of future cash flows decreases, even though the business is growing at 10%, due to the impact of opportunity cost. By discounting the 10 years of future cash flows at 15% per year, and also discounting the terminal value at the 10th year, we have calculated the present value of the annual future cash flows and the worth of the one-time check from selling the business. Adding all these discounted cash flows together yields the intrinsic value of the business today. In this example, with a 10% annual growth rate, selling at 25.5 times free cash flow in 10 years, and aiming for 15% annual returns, the intrinsic value amounts to $595.97 billion. If the market capitalization of the business is lower than its intrinsic value, it suggests that buying the business at its current stock market value could potentially yield 15% returns per year. Nevertheless, our journey doesn't end here. We need to incorporate a margin of safety into our intrinsic value calculation. The reason behind this is that despite our best efforts, predicting the future with absolute certainty is impossible. We must acknowledge that we will likely be partially incorrect in our estimations. Therefore, it is prudent to include a margin of safety in our assessment. The magnitude of this margin can vary depending on your preference. The decision is up to us. By purchasing the business at a price significantly below its intrinsic value, we effectively mitigate risk associated with potential deviations from our predictions. This provides a protective cushion if the future does not unfold exactly as what we anticipated. Furthermore, if our future estimates are reasonably accurate, the margin of safety can also enhance our overall rate of return beyond the calculated 15% per year. The concept of a margin of safety is indeed crucial. It is not only safeguards our investment, but also has the potential to boost our returns in favorable scenarios. With this understanding, we have now learned how Warren Buffett calculates the intrinsic value of a business, and we can apply the same principles. Take the opportunity to try it out on your favorite company and share your results with me. In the current market environment, it is likely that most businesses are trading above their intrinsic value, but surprises can always occur. Thank you for joining us in this enlightening journey into the world of value investing on the Investing Path channel. Now, armed with the wisdom of Warren Buffett's intrinsic value calculation, it is time for you to take action and embark on your own investing path. But before we conclude, let us reflect on what we have learned. How can you apply the principles of intrinsic value and margin of safety to make more informed investment decisions? Are there any companies you've been eyeing that could benefit from this approach? Share your thoughts and ideas in the comments below. Remember, successful investing requires knowledge, analysis, and patience. So, keep exploring the Investing Path channel for more insightful videos, tips, and strategies that will guide you on your journey to financial success. Don't forget to hit the subscribe button and click the notification bell to stay updated with our latest content. Together, let us navigate the exciting world of investing and pave our way towards a prosperous future. Investing Path, your compass to financial freedom.